Welcome to How Do They Afford That, the podcast that peeks into the financial lives of everyday Australians. I'm Michael Thompson. I'm a writer and the co-host of the podcast Fear and Greed Business News. And as always, I'm with Canna Campbell, financial planner and founder of Sugar Mama TV, the financial literacy platform covering YouTube and podcasts, books, Instagram, Threads, TikTok. I'm assuming you've added another couple of social media platforms since we last spoke last week.
Keynote speaking.
Okay, we'll allow that. I must remember to add that next time. Canna, hello.
How are you?
Oh, yeah, I'm going well, thank you. Reverse mortgages we're talking about today. Look at me just diving straight into this today.
I like that. Let's waste no time at all.
Reverse mortgages, I think, is something that everyone has heard of because you used to hear, well, you still do, hear about it in advertising a lot. You hear kind of a lot of references to reverse mortgages on radio ads and podcast ads and TV ads and things. Clearly, I'm a sucker for advertising. I just pay a lot of attention to what's being advertised. But I want to find out from you today what they actually are, how they work, who uses them, what the risks are, the benefits, all of it. It is, I suspect, pretty much a full 101 on reverse mortgages, which kind of makes you the lecturer, the reverse mortgage lecturer. If we're in kind of reverse mortgage university, RMU, you are the lecturer. How do you feel about your promotion to the new title of lecturer?
Do I get a pay rise?
You do not. No, it is actually,
Okay, Adam.
No, you actually do. Well, it's not a pay rise. It's a special treat. I have brought a special treat into the studio today and I've hidden it over this side. It is edible.
I like the sound of a treat.
You have said in the past that I know you have a fondness for cupcakes and various food things.
I am a cupcake snob. I have very high expectations.
Well, I'm prepared to both meet and exceed those expectations. We'll get to that a little bit later. Look, I'm luring you through the episode.
I'm actually getting a little excited.
Let's get into it. Reverse mortgages, obviously, everything that we talk about today is always general in nature. It's never personal, investment, strategic, or product advice. It is purely for financial education purposes only.
That's right. We don't know anything about your financial situation, the deadlines for your financial goals and dreams, what your risk profile might be, all those nitty-gritty important details that really help you get the right strategy in place. So always go and see a financial planner when in doubt.
Can I start at the very beginning? It's probably the best place to start, logically. What exactly is a reverse mortgage? I have no fear at all of asking dumb questions here. I'm going to ask the obvious one. What is a reverse mortgage?
When it comes to money, there are no dumb questions. You are safe with me.
I'm not. We have established this.
No, you're not.
Everyone
else except Michael Thompson is safe with me.
We've established this many times that I ask you something and then you just hammer me over for the next 20 minutes. But today is not that day.
All right. So a reverse mortgage is where you borrow money using your home as security. However, you don't actually have to make any repayments. The interest is charged back to the loan. So what we call capitalizes, it actually gets bigger and bigger. So it is a great way of, I guess, tapping into some extra money if you need it.
Okay, so you're borrowing against the value of your home.
Mm-hmm. There are no repayments.
No repayments. So I'm actually writing this down as we go because, we're all about financial literacy here and I'm increasing my financial literacy as we go. So borrow against the value of your home, no repayments, but the interest is just added on to the overall amount that you owe.
Absolutely. It's called capitalizing. So the loan actually gets bigger and bigger, which means you obviously get deeper and deeper into debt as the loan goes by. Okay.
So interest is added on then as you go. How much can you borrow? Is there a kind of a limit as to how much, whether it's against 100%? I'm assuming it wouldn't be 100% of the value of your home because then when they're adding interest and various things to it, you'd actually end up kind of owing more than the value of your asset.
Exactly. So it really depends on your age, but as a general rule of thumb, and you've got to be 60 to qualify for this type of loan, but between 15 to 20%. However, for each year that you're older than sort of 60, some lenders will potentially lend you an extra 1%, but it really is limited to that 15 to 20% range. So you have to be aware that it's not like you're going to be able to borrow 50% of your property like you have maybe in the past when you've bought property or used a gearing facility. Okay,
then we're really these are the nuts and bolts of this. What happens when you sell the property or perhaps when your estate, your deceased estate, essentially kind of sells the property?
So that loan is repaid in full at that point of time.
Yeah, and so that then includes then the interest and everything that's been kind of accumulating on there, and so that is just it just keeps growing right up until the moment at which it is sold, and then say you borrowed 20%, you are paying that original amount plus the interest.
Yes, and that amount of interest you pay is obviously subject to the interest rate, how long you've had that facility in place, and of course how much you've actually drawn down of that loan, because you don't necessarily need to take, that, say, $200,000 reverse mortgage loan in one lump sum. You might sort of take it in drips and drabs to help supplement your living.
Okay. There are, later in the episode, I think we might go into some of the different types of kind of reverse mortgage and similar kind of schemes, because there are other ones where it's essentially at a percentage of the house, and when the property sells, then the lender takes that same percentage out as opposed to the fixed rate, the fixed kind of amount at which you borrowed.
Yes, there are lots of different alternatives when it comes to looking at reverse mortgages. It's not just that's your only option. There are lots of different things to consider and think about.
Okay, all right. At risk of kind of getting myself confused, I'm just going to kind of stick to the basics for now before we kind of step up to the next level, which we'll do shortly. The fees involved in this, fees and interest, is it typically an interest rate that's the equivalent of like your kind of standard variable rate for a home loan, or is it a bit higher?
It's a bit higher, but you do need to shop around and you do need to go and get advice.
Okay, then who actually does it? Are we talking about banks here? Like, is it kind of your big four banks, or is it your kind of non-bank lenders, things like that?
Such a great question. So I did a bit of digging to see who's offering this, and it's mainly non-bank lenders.
Okay.
The reason why banks don't offer this is because it's a very complicated area. And you're dealing with possibly a client base where, financial literacy may be an issue. There are sort of lots of potential landmines and headaches that comes in with estate planning and, the amount of work that's actually involved. And these loans are actually quite small loans. If you can only borrow, say, up to, 20% of the property, or maybe a maximum of 25%, they're not particularly efficient products for a big bank to do. So they tend to steer away from it, which is why you've got a lot of these non-bank lenders stepping into this space. So
say you're dealing with a property worth, say, $1 million, right? Then they're only kind of issuing a loan of, say, $200,000 maximum.
Or 200 to 250. So the maximum limit's probably around about the 25%. But obviously you've got to shop around. Everyone's got different terms and conditions. Compared
to, say, lending 85% of the value of a property to someone buying their first house. And so they were buying the same property and it was $1 million and the bank was loaning $850,000 or something. And it was a 30-year term. There's a lot more profit in that for a bank than kind of a reverse mortgage on $200,000.
Exactly. And you add in the additional, legal complexities of, having to look at the estate planning issues and obviously that risk of making sure that the client really does understand the intricate nature of how this works, because it is obviously a reverse mortgage. Essentially, your bank is starting to own part of your home.
So who tends to use these then? I mean, you've already said that you need to be over 60. So we would be looking at essentially retirees, perhaps self-funded retirees, pensioners, perhaps just anyone who is looking to kind of get a little bit more money to fund retirement.
I would say classically, it's the asset-rich, cash-poor person. All their money is tied up in their property.
Okay.
And they are finding that, particularly the rising cost of living is, putting pressure on their income stream. They're starting to run out of money, and this is a great way of helping maintain, some form of lifestyle and income to meet the cost of living without having to be forced into a situation where you want to downsize necessarily or start selling off large assets.
Okay. And so that is why then typically you do see these ads aimed at kind of older Australians. And it is that emphasis on the asset-rich, cash-poor. It is, and a lot of the terminology you often hear is about unlocking the value in your home and stuff like that. And so that's really kind of where this is heading.
Exactly. And particularly for people who, might have, say, a medical expense coming up. It's a large medical expense. Yep. And it's a once-off expense that they need and they don't necessarily have it. They can't cover it through their income, or they don't have any other assets that they can release to help pay for that. That's another reason why someone might look into it. Or another consideration, which someone would have to be careful because obviously there's interest being attached to this type of product, is diversification. They've got all their money tied up in the home. They might use this type of strategy to help, I guess, accumulate assets in other areas that might grow. But again, factoring in the cost of interest. So, I mean, I don't know how much weight that argument really does have, but it is definitely a reason why someone might consider this.
I'm guessing then you say that and it sounds complex already. This is the kind of thing that you wouldn't just go into it blindly. You would need some advice on how to do it, and also then how to use that money then to, say you were accessing $200,000 in the value of your home and you were 65 years old, you would be wanting to get some advice as to how to make that money last and how to invest it in order to kind of fund kind of retirement.
Absolutely. You've got to see a financial planner to understand how to actually use that money, whether you take it in one large lump sum or whether you take it through an income style investment product like an annuity or another form of a pension, and then obviously what the underlying investment is behind that.
Yeah.
But that actually goes much further than this. You need to go and also speak to a lawyer, because you need to factor in estate planning and how does that impact the potential beneficiaries of your estate. And then, of course, you need to speak to, the product provider and she gets some advice as to which reverse mortgage is right for you, what's a competitive interest rate. And you might even want to also speak to an accountant in case there are some taxation issues. And whilst there is obviously no tax payable on the actual loan itself that you take, or whether you take it as an income stream or whether you take it in lump sums, there might be potential tax issues on the actual house, particularly if that house was previously, say, an investment property.
Okay. I know you mentioned before that a lot of banks tend to steer clear of it because it does seem like a lot of work and fairly low comparative reward. Did you mention mortgage brokers? Are they kind of involved in this?
Yes, absolutely. In fact, I actually spoke to a mortgage broker this morning just asking them some questions about this. So there are some mortgage brokers that actually specialize in this area.
Oh, really?
Yeah. So that's their sort of bread and butter. That's what they focus on. And that might be the right person to go to get quality advice, because obviously they're an expert in that particular field rather than just, doing a Google search and seeing whoever comes up first.
If they were specialising in that on the outside of their shop, would they kind of print all the words backwards because they are a reverse mortgage broker?
That is probably one of the worst dad jokes I've heard in a very long time.
So you're saying I shouldn't look as proud as I am right now?
No, definitely, please.
Okay, all right. I want to take a very quick break and we'll come back on the other side. I need to ask you very quickly about some of the risks involved in reverse mortgages, but I also want to talk to you about some of the other options that are available, because there's a number of different types of reverse mortgage style products, but there's also some other things that people can consider if they are looking to unlock the value in their home, and they don't even involve reverse mortgages at all. And so there's a bunch of things you should consider, and we'll go through those in a moment. Kind of, we're talking about reverse mortgages, really about kind of how to unlock the value in your home. I'm starting to sound like one of those ads that I was referring to before. I've just latched onto that saying and I'm sticking with it now. One thing that I was reading about, and look, I'd actually take this opportunity to say, if you are interested in any of this, go to the Money Smart website, which is a government website.
ASIC's website is absolutely brilliant.
Yeah, moneysmart.gov.au, and it goes through all of this, and it's in easy to understand language, which actually makes a big difference, doesn't it, when you can understand what you're reading? But they go through the different types of reverse mortgage and the kind of how they differ, because they do differ. There's kind of the standard reverse mortgage that we've talked about. There's home sale proceeds sharing. There's an equity release agreement. There's a home equity access scheme, which is kind of one that's run by the government. And we won't go into kind of all of these in detail, because otherwise we'll end up kind of trying to compare and contrast them all, and it will get a little bit confusing. Head to moneysmart.gov.au to check those out. The home equity access scheme one is an interesting one though, isn't it?
Yes, it's run by the government, and it is a lower interest rate than what you'd be looking at for, say, one of those reverse mortgage products. But that is something, when it comes to looking at these products, is you've also got to consider when you're doing this is the impact if you're on an age pension.
Oh, yeah.
Because, your home is excluded. So if you're suddenly getting $200,000, that may mean that you no longer qualify for an age pension, or you lose some of your Centrelink entitlements as well. So that's something that's also, you've got to sort of take into consideration. And the other big thing I didn't mention, and my apologies, is you're potentially going to have an issue if you need to do some renovation to your property or you need to make some changes. Because ultimately, and this is why you need to really check the fine print of these particular products. So if you're looking at altering the house and it's going to impact the value of that property, that could be an issue for whoever has provided you with this particular product. But yes, the government one is obviously available for certain people. Obviously, you've got to make sure you qualify for it. And you have to be an age pensioner to qualify. But these are the sorts of things that are, what I'm talking about. There's so many different options out there. It's not just reverse mortgages. That's all you've got. You really need to get advice and look at all the different things that are available. And in fact, can we talk about some ideas that are sort of non-financial product related to help people get some equity out of their home?
Yeah, absolutely. And again, just point in the direction of the Money Smart website, because it does go into some of the risks and things as well, and talks about the fact that the rules changed back in, I think it was 2012, about kind of reverse mortgages, where now there's something called negative equity protection built into all of these, essentially to ensure that someone taking out a reverse mortgage doesn't end up owing more money than their property is actually worth. And so it's just go and check this out. Let's veer away now from these kind of products. What other options are there then, instead of kind of having to go to a non-bank lender and look at a reverse mortgage, if you want to unlock some value in your property?
I think this is one that's got to be, considered with, from a point of compassion, because, you've got someone living in their home and they've been living in that home for a very long time. They've got roots planted, they know their community, they're comfortable, they feel safe, particularly when we look at an aging population and particular generations, that just being at home and being together as a couple, an elderly couple in particular, this is really important. So as I keep banging on about, it's not just one option of reverse mortgages. There are other ideas that you can consider and get advice on, and that is, for example, downsizing. You've got a home worth, a decent amount of money. It might be worth having a look around to see, okay, is this now time to look at selling the house and maybe downsizing into a townhouse or an apartment where you've got lifts or everything's on one level potentially, or close to the shops.
Yeah.
That can help free up a lot of money. And again, it may mean that you no longer qualify for an age pension. It may mean there might be some tax triggered, and obviously you've got, getting out of the market and stamp duty and so forth. But that is potentially a way to help do this without incurring the cost of interest through something like a reverse mortgage or the other products that you just listed off there.
There's a social kind of value to that as well.
Absolutely,
and isn't it? Because we are in a bit of a housing crisis at the moment. And by doing that, perhaps downsizing into a smaller property that might be more suited to your needs, then it is kind of freeing up a big family home to someone who's kind of at a different stage of life and in need of a bit more space.
And there's another argument for this, and obviously this is a sweeping generalization and it's not meant that way, but, you look at some people in their situations and they're, hell-bent on staying in their home, but their home is crumbling around them. And we've discussed this in the past. The cost of maintaining a property is expensive.
Yeah.
Getting a roof fixed, getting water damage fixed, just the natural wear and tear of properties, things that need to be upgraded, things that actually have fallen apart and are deteriorating and are now dangerous.
Yeah.
The cost of maintaining property is expensive. So this is a way of, freeing up, increasing the supply, but also just facing the reality that sometimes it actually is better for you financially and also mentally, physically and emotionally to look at maybe a more simplistic way of living and staying, within a home that you actually physically own and keeping up and be able to enjoy some quality of life as well.
Yeah.
Why do we want to live with, living in a home that's falling apart that's actually not being able to give back to us?
Yeah.
Maybe the better option is to look at something that's a bit smaller, free up some cash and be able to have money to go traveling overseas, or have that extra money to pay for extra medical treatment, or even to give more money to charity or to help, your family around you.
What other options are there?
There are lots of options. So another option is to look at renting that property out. So you could consider moving out of the property in its entirety and renting it out, and the rental market is quite strong at the moment. Or another great option, which I've seen quite a few times now, is where people have looked at renovating to the point where they add like a granny flat, or they rent a bedroom out to a student.
Yeah.
And that is another form of income to help support and supplement, the rising cost of living. So that's definitely another option. Again, this is why you go and see an accountant to see all the tax consequences of that. And another option, and this is a big, warning or, sign for people who are actually looking at coming close to paying off their home loan and are looking at retiring and are worrying about retirement, is actually keeping your loan facility in place. You still pay it off, but you don't actually close the facility off because you may actually look at the situation and go, all right, well, I need some form of reverse mortgage, but I don't want to pay the higher interest rate that comes with a reverse mortgage product. Perhaps I can use my existing loan facility and actually take the funds that I've paid off that are available in the redraw facility or the offset account. Obviously, again, you've got to be very careful with this and not go backwards, but that might be a way of actually being able to draw down very, very slowly with advice on your existing facility set up, paying an interest rate that's the current competitive interest rate rather than a reverse mortgage. But again, I must stress this has got to be done with the advice of a financial planner. And it's the big argument they've had with other people as to why they've kept their loan facility open, not necessarily to use this, but as a safety net almost, even though they've got lots of cash as well.
Yeah, because the downside to that would be that they then need to be making repayments. And
well, the downside, making repayments, of course, absolutely, because you are going backwards. But the problem sometimes happens is when people don't, they go to the bank and say, oh, look, I've got all this equity in my home. I want to borrow some money. And the bank say no.
Yeah.
If you've still got the facility in place, you can still technically use it. And I guess I'm being a little bit naughty explaining this, but I'm all about options.
Yeah.
And I have seen a situation where someone said to me, I closed my loan facility off and I now don't qualify for a loan. I wish I'd never closed that off. And we were just talking and chatting about this. So it's, again, this is why you go and get advice. And yes, you will have interest repayment. You will be charged interest, of course. That is an obvious one, but you must get advice. But it is something that it's food for thought, is what I'm saying.
Okay. Really, the take-home message here is that you need to get advice.
Very much so.
Yeah. Okay, that makes sense. Look, I think, if this was a 101 on reverse mortgages, I feel like I would now be graduating and able to move on to the next one. You've lectured well on this.
My job is done.
Yes, it is done because you taught me what a reverse mortgage is and the fact that you're borrowing against the value of your home and that loan will just continue to get bigger. The interest is added to it, but there are no repayments in that system, that you can be borrowing kind of 15 to 20 to 25% really, but it's not banks who are doing it. It is more often than not the non-bank lenders, that there is fees, there's interest, all of that is kind of rolled into it as well. That really this is a product that is for older Australians, that we're talking 60 plus. And it is about people who are, as you said, asset rich and cash poor. So it is about unlocking some of that value in their properties. And head to moneysmart.gov.au to see the different types that are available. Get some professional advice on it from an accountant, from a financial planner, from a lawyer, because there are implications for everything, for estate planning, for tax, all of that kind of thing. So it's not something that you would rush straight into or advise your family, perhaps your parents or someone to rush straight into, that it isn't something that you need to do in quite a measured way, that there are a bunch of different options for it. But then also outside of those specific products, outside of reverse mortgages and outside of the home equity access scheme, the government run one, and outside of the equity release kind of structure as well, that there are other options like downsizing your property into something that's perhaps more suited to your needs, and in doing so unlocking perhaps some of that capital, some of that value that you have that you've built up in that house. Renting it out, I think, was one that you mentioned, which is actually quite an interesting idea of kind of becoming perhaps a landlord later in life, because you are moving into another property and renting out the one that you perhaps lived in for 50 years, using features, your bedroom or perhaps a granny flat, renting that out and bringing a little bit of extra money in. And also the option of perhaps using your existing loan facility and the redraw that you have, perhaps based on what you paid off over the life of the loan. So it's which is something that you do need to get advice on.
Absolutely.
The whole way through. I think we're done. We do need a savings hack from you. Have you got one for us today, Canna?
Do I have one for you?
I hate kind of giving you that opportunity. I really just wish I had one that I could just... I mean, you can't see this because obviously this is a podcast, but I'm just like demonstrating that I'm just kind of flinging a savings hack at you.
I
have you got?
have like a phone book of saving hacks. Now, this is from Rebecca, who very kindly sent this through to me on Instagram. And she said, just a money savings hack at Petstock. If you buy certain brands of food or fleet treatments, you get cash back to use on those brands later. I went to buy Bravecto, which is actually the one I use myself for my dogs, Giuseppe and Peppy, for my dog, which is expensive. It's actually very expensive. And I found out that I had about $35 sitting there from previous purchases. Usually I go to Petstock online when Cash Rewards has 20% cash back. So for $100 item, I might get 20% cash back on Cash Rewards and then 15% on Petstock brands and use the remaining money sitting on my Petstock rewards. So actually she's really triple dipping now that I think about it.
Yeah, that is great.
Because she's getting money back from Cash Rewards. She's getting a great discount from Petstock.
Yeah.
And then she's also earning points as well with Petstock for even further savings and money back.
That's fantastic. Thank you, Rebecca. Thanks for sending that one in. I would prefer you send it directly to me at Michael Thompson Author on Instagram, but the fact that it made it here at all is actually good. So thank you very much for sending that in. Kenna, would you like a cupcake?
Oh my gosh. Okay. Sian makes the best cupcakes in the world.
Well, and because you had one of these at my book launch last year.
And I'm really excited about you writing your second and third book, just because I know it means I could potentially get my hands on more of Sian's cupcakes, which are amazing.
We can have cupcakes that are not tied to book launches. There's a lot less work involved in that. But you know what? And so these ones are even done in, how do they afford that, colours. There's pink and kind of light blue. They do look like gender reveal cupcakes, but they are in fact, how do they afford that, cupcakes. So I hope you enjoy.
Oh my gosh, I
Look at
am
that.
so excited.
Isn't that friendly? That's I'm calling myself friendly. Yeah.
Did you get up at, what time in the morning and make these cupcakes?
Well, it wasn't me,
Obviously.
but yes. Anyway, look, there we go. I mean, it's a very kind of visual thing that we just did for a podcast. So I don't know really how well that works. But anyway, if we need...
That's why everyone needs to be following us on Instagram, because you can watch these podcast episodes rather than just hear them.
That's right. And so where do we find you?
At Sugar Mama TV on both Instagram and TikTok.
Excellent. And you can hear me every day with Sean Aylmer on Fear and Greed, Australia's best business podcast. We are also on Instagram and TikTok, Fear and Greed Podcast. Thank you very much for listening to How Do They Afford That? Remember to hit follow on the podcast. And the very best thing that you can do to help us out is to tell somebody else, to spread the word about How Do They Afford That and help us recruit a few new listeners. Next week, we are talking all about reverse mortgages. It should be an interesting conversation. Don't miss it.